So, Dr. Murphy here is a name I'm sure many of you are familiar with. He is the author of Choice, Chaos Theory, and Lessons for the Young Economist. He is the host of The Bob Murphy Show and the Human Action Podcast, which I'm sure a podcast many of you have listened to. And he apparently also has some pretty legendary karaoke skills, which some might say is his most impressive accomplishment. But with that being said, Dr. Murphy, you have the floor.
Great. Thanks so much, everybody, for showing up. And to echo those comments, yeah, I remember I participated on this Discord a while ago, and I remember it was a very, how am I trying to say? I was able to get deep into, I think we were talking about capital and interest theory, and I was really able to go much deeper into that than I have done in any other kind of, discussion forum. So I appreciate that. So what I'm going to do, for the time I have for the prepared remarks, and I'm certainly looking forward to your guys' questions, is I, believe it or not, I actually think right now is just like having a background in the classics of Austrian theory is just equipping me. I'm just like able to comment on things that are actually relevant to normal people, right? Like so what it used to be was sort of like, oh, if you liked Austrian economics, it was this niche thing, and you had to go around, and it was very rare if you could find, and if you did find someone who had also read Rothbard, then you'd be lifelong friends and have a conversation, or whatever. But other people, even other economists, didn't know about it. And then when Ron Paul, got real big with the last two presidential runs, he sort of put Austrian economics on a broader map, and more people got interested in it. But what I'm saying now, it's just there's a lot of developments where it's just natural. It's not even like ideological. It's just that the tools that the Austrian school provides are allowing me to interface with people, not just economists, but like people in the financial sector. And it's really just, I'm so glad that I specialized in this area. And so specifically things like the Misesian approach to money and banking and capital and interest theory and the business cycle, that stuff is just, I think just way better prepared to deal with new stuff that's coming, hitting the financial market. So that's what I thought I would spend some time discussing. So since I brought it up, let me just mention, though, I don't want to dwell too much on this because I did spend so much time the last time I, was a guest on this Discord. The as far as the pure time preference theory of interest, there have been, I would say, advancements. Per Byland has a book, like it's a compilation of essays in Austrian economics that he got one the Algar series, and I have a chapter on the pure time preference theory, and I think that the work that Jeff Herbner is doing is actually what 30 years from now, people who are going into Austrian economics and they want to see like what's the Austrian view of interest. I think that Jeff's approach is what's going to win the day, and I make the case for that. So I'm not going to dwell on it right now because I want to hit this other stuff. But in the Q&A, if you want me to elaborate, I will. So let me just say, like, my concerns and critiques of, if you've read Human Action or Man, Economy, and State, and you see how Mises and Rothbard talk about the pure time preference theory of interest, my objections to that approach, I think, are still valid. What Jeff Herbner, and so I had proposed, I was, for lack of a better term, I called it a monetary approach to interest. And by what I meant by that was to distinguish it from a real approach. Because I was saying the pure time preference theory, it's a real approach. It just, the essence of it, to say present goods are more valuable than future goods. You're not making it about money, you're making it about goods. Oh yeah, I'd rather have an apple today than an apple 10 years from now. That's time preference, baby. And so I was saying it's step one, that's not fruitful, and it's certainly not Austrian. Okay? And so that was my concern. So in reaction to that, I called my approach a monetary theory because I was saying, no, what interest is, it's an intertemporal exchange rate between, present money and future money. Just like, in the Forex market, like the US dollar versus the Japanese yen or against the euro, those are currencies, and that's what exchange rates are. You can think of interest rates as a US dollar today exchanging for a US dollar 12 months from now. Think of it that way. And I said, Some of you are probably thinking, Bob, for not talking about this, you're sure talking about it a lot. I know. I'm gonna end very soon, but once I started, I can't stop. And so my analogy was to say, no Austrian, if you were trying to explain the exchange rate between the U.S. dollar and the Japanese yen, would ever say, "Oh, it's because American goods are preferable to Japanese goods." Like, there's so many things wrong with that statement from an Austrian perspective. You know what I mean? It's like not even an economic state. Like, just, there's no marginal analysis. What do you mean American goods are preferred to Japanese goods? That's like, who talks like that? And yet, when we're trying to explain why does $10 today trade for $11 12 months from now, we say, oh, because present goods are more valuable than future goods. And so, like, to me, like, after spending all of my time writing my dissertation, I had gotten to the point where that statement, present goods are more valuable than future goods, like, causes me physical pain. Just like to say American goods are more preferable to or more valuable than Japanese goods would cause most Austrians to recoil and say, "What are you talking about? That doesn't even make sense." Okay, so that was but the problem with me calling it a monetary theory was it sounded like it was Keynesian, and so Herder proposes what he calls a calculation theory of interest, and in that I think is a better label. And also, it's not that he came up with that. There's stuff in Frank Fetter where I think Jeff got that idea from to call it that. And so I think that's, so it captures the best of both worlds, that everything that was right about what we could now call the pure time preference theory, all those insights are still in what, Jeff is proposing, but it has the critical element that everything has to get run through money prices. And that, last thing I'll say on this is where I was coming from was to say that's one of our key complaints as Misesians against the neoclassical mainstream is they, to this day, solve an economy or solve the equilibrium by computing the barter exchange ratios. Like, oh, how many apples trade for how many pears, and how many, a one worker hour trades for how many, cars or whatever. And then, but since in the real world there's money in our model, let's go ahead and add money as an afterthought. And Mises objected to that and said, no, you have to, from the ground floor, include money because there's the driving force of money. And so he was objecting to his colleagues, even back then in the day, that they were still thinking about the economy in a barter framework, that they were getting from like Walrasian equations or something. And he was saying that's wrong. And so I'm saying, likewise, Austrians, ironically, in the Misesian tradition, when they were thinking about interest, they weren't thinking about money. They were thinking about, trading pizza today for a pizza not available 12 months from now. And so I'm saying, why, we're doing what the neoclassicals do with everything when it comes to intertemporal exchange. Okay, so I'll move on from that. A big thing is the yield curve. All right, so I've spent a lot of time, if you're listening to the Human Action podcast, we talked about this a lot. I had Paul Swick on. That was his doctoral dissertation. So I won't spend too much time on this, but this is an area where, again, it's just like, oh, thank God I'm an Austrian, right? And woof, I'm glad I'm not a Keynesian. So again, I just love it when there's examples like this, clear cut, where the Austrians just clearly are better than the Keynesian counterpart. So real quickly, in case you don't know, ever since at least the 1980s, there has been this empirical pattern that people in the financial sector have recognized where when the yield curve inverts, meaning when the interest rate on short-term government debt, like a 3-month treasury bill, right now that's trading above 5%, in terms of an annualized rate of return. So normally longer-term bonds have a higher interest rate than short-term ones. In other words, intuitively, if you're going to lend money to the government for 30 years, you insist normally on a higher annualized rate of return than if you only lend money to the government for 3 months. But when the yield curve is inverted, that pattern gets flipped, and the short-term yields are actually higher than the long-term yields. So historically, at least from World War II onward, if you define it appropriately, and it's not like you gotta, bend over backwards and do really ridiculous judgment calls, but meaning like the yield curve has to invert for some duration. It can't just be like during one trading session it briefly flipped for a couple hours and then went back. Like when we say the yield curve inverts, if we mean like the spread between the 10-year and the 3-month was negative for at least a couple months, that kind of a thing, then whenever that has happened, there has within like the next 18 months typically been a recession. And also, again, from at least World War II forward, every recession has been preceded within like 18 months or so by a yield curve inversion. So if you're using a yield curve inversion as like an indicator or a signal about an impending recession, it has no false positives and no false negatives. Now, little footnote, purists can quibble. There's a couple borderline cases where, depending on which, do you use the 2-year or the 10-year, and depending on what you use, there might have been a slightly inverted yield curve, and then there wasn't a recession. There was just like a slowdown in growth or something. You know what I mean? So, but even there, that's kind of the exception that proves the rule, that it didn't quite get classified as a recession, but it was still a slowdown, and the yield curve inversion was really modest. Okay, so even there, it kind of still, is consistent with the pattern. But anyway, that's the pattern. So then the question is, how do you explain that theoretically? So one approach, and this is something that Krugman explicitly laid out in his New York Times column when he was teaching the readers of the New York Times, this is how economists think about the inverted yield curve and why does it work, or why does it work as a forecasting tool? And he said, because what happens is, so what does it mean to say the yield curve inverts? It means that, again, the yield on longer term government securities is lower than the yield on shorter term ones. And so Krugman says, the reason that happens when a recession is imminent is that people in the financial sector, bond traders, they can tell, boots on the ground, they're kind of, they're on the front lines. They know that things are starting to fall apart in the economy, and they know, if there's going to be a recession within 18 months, more and more people in the financial sector start to know that, or to start anticipating that, right? And so the more pessimistic they get, they are forecasting, so if 18 months from now we think there's a higher and higher probability, as we keep getting more data and stuff that's pessimistic, there's more and more higher probability there's going to be a recession at that point. And right now, when I'm making my forecast about what's the short-term interest rate going to be, like what's the Fed funds rate going to be 18 months from now, I'm going to keep marking that down in my forecast the more pessimistic I get. Because we're assuming that, the Fed basically controls short-term, very short-term interest rates with monetary policy. And if we're in a recession, the Fed's going to slash rates. That's what the Fed does when the economy's in recession. Okay? So if you think a recession's coming, you think short rates in the future are going to be lower than they are right now. So then what does that imply in terms of arbitrage for longer term bonds? Well, obviously the average yield on them gets pushed lower, right? Because, there's a sense in which it can't be that people expect short term, like 1 year rates, you can't expect them to be 5 right now and then drop to 1 next year. And yet you would be willing to borrow money on a 2-year bond for 4%, right? To pay 4%. Because you would say, no, let me just pay the 5 now, and then when interest rates drop to 1% next year, I'll roll that loan over and then borrow only at 1%. See what I mean? So if you think short rates are going to be lower in the near future, you as a borrower of money are not going to pay high interest rates on longer term bonds that cover that whole time span in terms of what's the average yield on that bond. So Krugman's basic story was people, as the recession gets closer, people more and more start to realize bad times are ahead, and that pushes long-term yields down such that they eventually cross over and go below where the short yields have been all along. And that's why the yield curve inverts shortly before a recession. So theoretically, there's nothing wrong with that story or that explanation. It's internally consistent. It's a little bit weird if you think about it, because it's like kind of explains, the reason the yield curve is a good signal if a recession's coming, and the reason a trader might look at the yield curve to get some insight is because we all know a recession's coming, and so that's why the yield curve tells us a recession's coming. So that's why it you know what I mean? So it's kind of like the only way that story works is if at least a bunch of people already knew a recession was coming, so there's not really that much information contained in it. So that's something that's kind of quirky with it, but fair enough. But the real problem with that story is empirically, if you go and disaggregate, and I've done this, if you Google Robert Murphy Mises.org yield curve, you'll see it. The article I have in mind. It was also a chapter in my book, Understanding Money Mechanics, if you want to look there. And it ties in with work that I did with Ryan Griggs. But anyway, if you so what Krugman's explaining is why the spread between the 10-year and the 3-month goes negative before a recession. But his story again involves 10-year yields plummeting, dipping below the 3-month yield. But if you look empirically at what actually happens, it's the other way around. Going into at least a lot of the recessions in the post-war period, certainly like it's crystal clear right before the 2008 crisis. That's a just pure refutation of Krugman's theory. It's what happens is the 3-month yield shoots up above the 10-year yield, and then after some while, then the 10-year does start going down. And so I would argue, and I have argued, that is entirely consistent with the standard Misesian story of what causes the boom-bust cycle. All right, so I'm kind of burning a lot of minutes here. Let me just say this real fast. So the idea is, normally when we tell the Austrian story, if we're trying to boil it down and just tell it to a lay audience, they'll say, oh, the banking system, or we might even just say the central bank if we're trying to be quick, but it's more accurate to say the banking system. During a boom, they flood the market with cheap credit. That pushes the actual market rate of interest below the natural rate. That falsifies entrepreneurs' estimates of profitability for their long-term projects. It makes longer-term projects seem more profitable. And so, that sets in motion the unsustainable boom. Then price inflation starts getting out of hand. The banks get worried. They tighten. Or, if there's a central bank, then the central bank might tighten and raise rates. And by which they mean they stop pumping in more money, or they slow the rate of growth of the money stock. And that makes that makes the interest rate shoot up, and then there's a bust. But in reality, there's not just the interest rate. So if you ask the Austrian, hey, elaborate a little bit more on your theory here of the basic Misesian framework, when you say the Fed, for example, in the U.S. context, cuts interest rates and that causes a boom, and then jacks up interest rates and that leads to a bust, which interest rate do you mean? And most Austrians and other economists would agree the central bank has a lot more control over short-term rates than over long-term rates. So in particular, if the Fed's pumping in a bunch of money, that can push short rates down, at least temporarily. And if anything, it makes long rates go up a little bit because people are building in higher price inflation expectations. So if the Fed now is pumping in money, people might want to have a higher yield on a 20-year bond because they think prices are going to rise more. So they don't want to get paid back or they're going to get paid back in weaker dollars. So they're going to insist on a higher nominal rate of interest. So that's why, loose monetary policy can lead to short rates going down and long rates, if anything, going up. And then vice versa, if the Fed slams on the brakes, it's the other way around. That short rates can skyrocket, but if anything, long rates might come down a little bit because now they're saying, oh, they're pumping in less money than we projected they would, as of last Thursday when we looked forward. Now the Fed surprised us by a huge rate hike, which, we know that means how do they accomplish the huge rate hike? They don't pump in as much money over the next, few years. And so if anything, that might make you as a lender tolerate lower long-term yields. So long story short is the Austrian story, if you start getting more specific about there's a whole yield curve and how do you take the Misesian story and embed it in a framework where there's multiple maturities on different types of bonds, it would be, during the boom, the short rates get pushed down and long rates, if anything, get pushed up. And then when the banks tighten, short rates shoot up and long rates, if anything, go down. And that's exactly what we see in the data. And then shortly after that tightening, there's a recession. So it's not that, Mises, I don't recall him ever, if somebody does know an example, maybe I just wasn't aware of the yield curve when I read him at the time, and so that's why it didn't stick. But I'm not saying Mises predicted the yield curve inversion or talked about it, but I am saying his basic story is fully consistent with the fact that the yield curve inverts like that. And again, the Austrian story fits the data, whereas Krugman's story just flat out doesn't fit the data. Okay, another example is when it comes to, there's a lot of talk like with Bitcoin and other cryptocurrencies and like the scaling problem, and it's only can do 7 transactions a second, and what do we do? And I'm not going to dwell on it here too much because I think you folks are probably really experts on these topics. In the Q&A, if you want to pursue it, we can. But I'm just mentioning that just having the Misesian taxonomy of money in the narrower sense, and then money substitutes, and a money certificate versus fiduciary media, and what does Mises mean, and all that kind of stuff. It's just been so helpful to me talking with people when they're saying, oh, what happens like if Coinbase has your coins and this and that, or like the Lightning Network and we're taking it, and is that fractional reserve? So I'm just saying it's real simple for me to like talk about, is this going to be inflationary or not, and blah blah blah. And it's I can just tell like other people, certainly if they don't have an economics background, but even economists, if they haven't, even if they have studied monetary and banking theory, the frameworks they're bringing, they learned, if they didn't learn the Austrian approach, a lot of times I just think it's unhelpful. Whereas again, having that background with me, even though obviously Mises wasn't talking about Bitcoin, and some would argue his regression theorem was at odds with it, but my point is just having that background and having thought through the Misesian categories, it just makes it real easy for me to analyze a situation when people are talking about, is this money or is it a claim on money, and blah blah blah. Like, it's just real crystal clear. So going along with that, with the failure of Silicon Valley Bank and related institutions, and that has engendered, I don't know if this is all on all of your radar, but there is the people in the financial sector who are not ideological are extremely receptive now to 100% reserve banking. And like that idea, it keeps coming back. And let me just mention, if you had this idea that that's some crankish notion that only Rothbardians advocate, that's just not correct. Like Irving Fisher back in the 30s, they called it the Chicago Plan. Go look that up. Right, the Chicago Plan is 100% reserve banking that was advocated in the 1930s because they saw in the United States what happened. All these people were running and taking their money out of the banks when a few banks started going down, and then that's what caused M2 to shrink by 1/3. Right, so Milton Friedman's and Anna Schwartz's famous explanation of what happened. Why was there the great contraction from 29 to 33? And they said, because the Fed didn't inflate enough to counteract the public pulling their money out of the banks. Well, okay, but the only reason the public doing that mattered was because of fractional reserve banking. If there had been 100% reserve banking, it wouldn't have mattered whether the public pulled their money out or not. That just like whether you hold your $100 or whether you hold your money in a brown wallet or a red wallet doesn't matter. It doesn't affect the stock of money. Likewise, under 100% reserve banking, whether you have your money in the bank, in a checking account, or in your wallet, it doesn't matter. Okay, so anyway, I'm just saying, a lot of times the shock troops in the online arguments about free banking will say things leading you to believe that, this is just some cranky thing that these internet Austrians who like Rothbard over here, but no serious economist, and that's not true. Even guys recently who won the Nobel Prize, talked about that, and they weren't necessarily endorsing 100% reserve banking, but they were saying, the problems with fractional reserve banking, and this is a serious issue, and blah 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 blah. So anyway, I'm just saying that that's getting a much fairer hearing, I would say. And if you're not aware, a bunch of economists were writing in support of what's called the narrow bank. It went by TNB, the initials, the narrow bank. And what it was is, I think John Cochrane was sort of like a champion for it. And that's not even the right term. He wasn't a champion. He was just saying, what the heck is going on? How come the Fed's not giving these guys a master account? What's the deal here? Shouldn't everybody be in favor of this proposal being an option for people? So what the narrow bank was doing was I think they were out of Connecticut, was where their charter was. So they had a state charter, so they were an actual bank that was up and running, but they were applying, to be a part of like the Interfederal Reserve System. I think the term would be to get a master account, but I might be fumbling the terminology a little bit. And the reason they were calling themselves the narrow bank, and they were saying all we're doing is narrow banking, is they meant all we're doing is customers, our institutional clients give us deposits, and then we go ahead and, if we get approved, and now we basically have a reserve account with the Fed. And so now we just park our clients' deposits with the Fed so we can earn, so at this point, the Fed was paying interest on reserves. I don't remember when the narrow bank actually made their first application, but this proposal arose after the fall of 2008 when the Fed was now paying interest on reserves. And so the idea was, and the rationale was, hey, this seems kind of unfair that the Fed is paying interest to these elite cartel of banks, whereas other people, not just like mom and pop, but like, major corporations, they don't have access to that. Like, it's not that regular companies even can have a checking account with the Fed itself and then get paid interest on reserves. And so what they were earning was slightly lower. So what the narrow bank's whole business model was to say, we're going to say to our institutional clients, you park your money with us, we'll go ahead and park it at the Fed, and then we'll pass through to you. And the reason they were called narrow is because they weren't going to make loans. They weren't going to be like a regular, bank that would take deposits and then loan out money to people, for mortgages or car loans or whatever. They're just like, nope, all we're doing is parking your money at the Fed and then pay, taking a little bit off the top to pay our bank tellers, and pay for the lights and stuff. But other than that, we're basically just passing it through. And the Fed kept coming up with bogus reasons to deny their application. And as far as I know, they still haven't approved it. And the narrow bank even filed a lawsuit, to say, there's some government regulation saying you have to comply within a certain amount of time, blah, 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 for efficiency and government operator, some oxymoron like that. But the point being, so cynics were saying, see, they don't, the old boys network doesn't want to let everyone else in the joint. And I'm not even saying it's a good idea. But my whole point is just to say that the people like Cochran, when he was touting this and saying, why aren't we talking more about this? Shouldn't we like this alternative? As he was saying, the whole problem with the regular banking system right now is that, people can go ahead and put their money on deposit and think it's in the bank. But if the bank lends it out and then there's a run, nope, it's not there. And he's saying, so wouldn't it be good for people who really just want to have safety? So anyway, it was also sort of a counterexample to, as you guys can gather, I'm a fan of 100% reserve banking, although I have respect for Selgin and White and that camp. But one of their standard talking points is to say, it's not illegal right now to have 100% reserve banking, but it fails the market test. But is the narrow bank, and then Caitlin Long also, if you know her, she's been applying to try to get access to the Federal Reserve System, and they keep denying her application too. And what she would have would be 100% backed. Now her stuff involves crypto, and so I can see why if they just kind of don't know what to do with that. Like, there's more moving parts with what she's doing. Whereas the narrow bank, it's just open and shut. They're not doing anything nutty. In fact, it's real simple. And yet, the Fed wouldn't, and again, the concern, I think, the Fed people were saying, well, gee, if we do that, wouldn't everybody just pull their deposits out of the other banks and park them here? And they didn't want that to happen. Certainly, the other banks didn't want that to happen. Okay. Let's see. Another area is when it comes to the alleged threat of super AI. And so here, I went to, if you guys know who George Gammon is, his podcast is called Rebel Capitalist. He wears a ball cap usually that says "End the Fed" on it. If that's if he's familiar to any of you. So anyway, he had a live event in Orlando in May. It had me come down and be one of the speakers. And I was trying to come up with something out of the box. Like I didn't want to just talk about fractional reserve banking or something boring, because this was a different crowd for me. Like the people in this crowd didn't necessarily know who I was. So and he said, just talk about whatever interests you. And so I had been on the side, kind of going back and forth with Spencer Schiff, who's Peter Schiff's son. I wonder if Spencer doesn't like being known as that, but that's who he is. And he's all big into worried about AI, like thinking people aren't taking the threat seriously. So he's sending me all these articles of guys saying, "Oh yeah, they're definitely just going to exterminate humanity. It's not a question of if, it's a question of when," that kind of stuff. So I started developing arguments to show why I wasn't worried about that. I mean, so between us, the main thing is because I believe in God, and Jesus can stop the AIs if he wants to. So that's the real reason. But in terms of economic reasons, what would I say to somebody who isn't going to listen to a theology? I was pointing out that I was using standard Misesian arguments to show why slavery was inefficient. And so I went to this conference and I spent some time doing that. And then I switched, like I didn't mention AI at all. I was just talking about, and the news hook I used was the argument over reparations. So in the United States right now, a big topic that it kind of flares up every once in a while and then it dies down, and it kind of flared up again, or at least a few months ago it did, where people were saying, oh, the government should pay reparations to Black Americans because of the legacy of slavery. And so my argument against that was to say, yes, obviously slavery was bad and made Black people poorer than they otherwise would have been. But I said it also made white people poorer than they otherwise would have been viewed, as collectively. Like maybe certain individuals benefited, but in general, no. White Americans are poorer in the year 1900 because slavery existed than they otherwise would have been. So it makes no sense to take money from white people basically to give to Black people, because there was no boon to the one. It wasn't like extracting rent from one group and now today's light-skinned people inherited all that ill-gotten gain. No, everybody lost. Some people lost more, don't get me wrong, but there's no gain to be repatriated. So that was the argument. So I went through that, and the way to make that argument, I was just relying on stuff that Mises taught me in Human Action. And he, explaining that slave labor is inefficient, it's unproductive, humans are creative, entrepreneurial. You want workers to be brainstorming about how can we improve the efficiency of this enterprise, and you don't get people to do that if they're slaves. Okay, so I'm going fast with the argument, but where I even came up with that idea was in Human Action. So I go through all that, and then I switched, and it seems like I'm talking about something completely different. I start talking about super AI, and I talk about Chat GPT and whatever. And then I have a big thing on the PowerPoint saying, are the AI going to enslave us? And I just leave it sitting up there, and I'm looking at the crowd, and they're kind of like, I don't know. And then I say, well, not if they've scoured the internet and George has made my presentation, put it online. And then people, as they start to get what my point was, they start chuckling. I was saying, I just walked through and showed you that slave labor is inefficient. So even if the AI, quote, take over, it wouldn't be in their interest to enslave us because that's inefficient. And so, I go through it. So anyway, so that was just kind of a neat little thing where, again, my background and the fact that I had read Mises, he gave me, and I'm really surprised. Like I then went later and did a podcast episode. I'm going to actually write up an article later this week for this, but just using like standard comparative advantage stuff, right? To say, even if even if the United States workers are better in terms of absolute advantage at producing everything compared to workers in Bangladesh or Mexico or whatever, it still makes sense. Americans are still richer if they specialize in their comparative advantage and then trade. So by the same token, when people are like, oh, how could humans last if the robots powered by super AI are better at everything, we won't have any jobs. It's like, no, we'll still have a comparative advantage in something, and that's what we'll specialize in. And then the world will be so ridiculously wealthy, that yes, if you want to think of it this way, maybe what humans earn through their labor is now only 1% of GDP, in the new equilibrium, whereas now it's whatever 70%, or maybe even 0.0001% of GDP. But what if that means, we only get 6 interstellar spacecraft, whereas this other guy who invested early and got a bunch of computers and has all these AI software enterprises, he owns 16 galaxies. Wow, that guy's so rich compared to me. All I do is have 16 spaceships. It would be something like that. Is what I'm getting at. Okay, I'll stop there and turn over your guys' questions.
All right, so I'll go and kick off the questions as a question of my own. And as it pertains to the calculation theory of interest that you discussed at the very beginning there. And my question is, if we adopt a calculation theory of interest as opposed to the more traditional, like pure time preference theory of interest, what sort of implications does that have on the broader corpus of Austrian capital theory, and I guess maybe more specifically business cycle theory as well?
Great question. I need to think more about that, obviously, but off the top of my head, and I'll try to keep my answers here brief to allow for more questions. So I think actually it reinforces, the standard, like Austrian business cycle theory. I think the level of the interest rate really is the issue, and it has to do with money getting pumped in and perhaps sucked out and whatever. And so I think it actually dovetails more nicely with. I think it was the original pure time preference theory. It was a little bit awkward to how to, fit that into the story of the business cycle. I guess just having to be a little bit careful about, saying things like, the consumers. If they, I'm trying to think of the way like I've been doing it. Normally you say stuff like, the consumers, if their time preference goes down, they're willing to save more, and that lowers interest rates, and that's a sustainable expansion, lengthening of production processes, but blah, blah. So I guess just being a little bit more careful about not making sweeping generalizations and being more accurate, which is not something anybody would have objected to even originally. Like even if Herbner and I never came around, like to say it's not that all the consumers simultaneously decide they reduce their preference for present goods in general. So it's always working through individual markets. So I think it just was sort of refining things. So I don't think it has any major ramifications in terms of, there goes Austrian business cycle theory. No, I think you still can tell the standard Austrian story. It's just, this is a little bit more robust.
Next question here comes from Castor Troy, and he asks, from an Austrian point of view, what is a comprehensive definition of a recession?
Okay. So here I'm going to be winging this. I can't remember off the top of my head, like if Mises or Rothbard ever formally spells that out. So I guess let me answer it this way. In the Mises theory of the boom bust cycle, what is characteristic of the bust phase? I would say it's that factors had been channeled into unsustainable lines or enterprises, and they need to get reallocated, and that there's a period there, like that can't happen instantly. There's a groping process involved where the people running those factories need to just lay everybody off. Like that's how you stop the bleeding, and then those workers have to be unemployed for a while to search around for where should I go now. And it's painful because they're going to necessarily get paid less, because again, in the original, the boom was unsustainable. People thought they were richer than they really were. So that means the people getting laid off are going to typically, end up in worse jobs compared to what they thought they were doing in the boom. So I guess that's what I would say, that there's a bunch of resources that need to get reallocated because of a prior credit expansion.
Next question here comes from Joey, and he asks, do you have any thoughts on whether the lockdown imposed economic hardships in 2020, quote unquote, concealed an impending recession?
So that's good. I think I'm answering your question. So in the summer of 2019, the yield curve inverted, and I was predicting a recession. It was going to happen, within 12 to 18 months. And so when the lockdown, if you go look at the official things, I mean, yeah, it's like there's a sense in which that was the worst recession since the Great Depression, in terms of like the unemployment rate. So yes, if this is what the questioner's answering or asking, I think had COVID never happened, no lockdowns happened, I think there still would have been a pretty severe recession in like the summer or maybe the fall of 2020. And I think what happened is the Fed came in and just pumped in a crazy amount of base money that dwarfed even what they did during the rounds of QE, following the 2008 crisis. So I think that's why things didn't seem so, but you know what I mean? Like, in other words, once they lifted the lockdowns, it seemed like it was okay. I think that was partly because of what the Fed did. Whereas if they had just had a more normal run of events, I don't think the Fed would have been allowed to pump in as much as they did in response just to, quote, a regular recession. Well, I think it actually would have been a bad recession if COVID hadn't happened. But I think with COVID, that did kind of mask things, if that's what the questioner's getting at.
Next question here comes from Franzel, and he asks, besides your own book, Chaos Theory, what other sources would you recommend for law and jurisprudence, tough word to say, jurisprudence in a pure private law or ANCAP society? And also, do you have any karaoke tips?
Okay, the karaoke's one. I'll do that first. So, big one is hold the mic like really close to your mouth. Like that's a mistake. Like the kiss of death is if nobody can hear you. So like if you're worried about doing it, a lot of people, they hold the mic far away thinking, oh, this way I won't. But no, there's nothing worse than somebody up there and you can't even hear them. That's just like people just tune you out and they, talk to their friends. Let's see. As far as, so I'll explain some of the things that I read, like the classics that helped me get to the point. So then, when I wrote Chaos Theory. So if you've never seen it, what's really good, excuse me, is Bruno Leoni's Freedom and the Law. So you spell Leoni, Leoni. And what I liked about that is he really drove home. I was reading that, and also Hayek's Law, Legislation, and Liberty. I don't think I read all three of the. I think I just read the first volume, but it was like Bruno Leoni and Hayek. They really drove home to me when I was reading that stuff the distinction between legislation and law, and I think that's critical to understand if you want to like believe in your bones that a private or voluntary legal system can work. And so the distinction is, in case you haven't heard that, because nowadays people almost use those terms interchangeably, but what they were stressing was they were saying no, it's a relatively modern, by which they mean within the last 1,000 years, so they don't mean like last 20 years, is a relatively modern in human history that the political or authorities think they have the ability to say what the legal rules are. So yes, you go way, way back, the king or the tribal chief or whoever would agree that murder is illegal. It's against the law, and if somebody murdered somebody, there would be some kind of legal sanction. But if you said, to the king, well, why is it illegal? He wouldn't say because I said so, or he wouldn't say, oh, because this group of elders voted a certain way, or no, it would just be like, well, it just is. Like, of course it's illegal. It's against the law. What are you talking about? Right? So that's the distinction they were making, that it used to be that even the political authorities and whatever, they or judges, they just thought they were taking the law, which existed independent of human whims, and were applying it to specific cases. And it was only much later did rulers develop the hubris to think they could, prescribe what the laws should be. And so they use the term legislation to distinguish that. So that was Bruno Leoni, Freedom of Law. Also, the Tannehills is very good. So I think everybody, like, obviously you guys know Rothbard and Hoppe. David Friedman has some cool stuff. You should read his. I don't agree with a lot of the places he ends up, but it's good just to read his descriptions. But one that maybe you haven't checked out is Linda and Morris Tannehill, and that's what Tannehill. Look up their stuff. Like that was really interesting to me and like helped me get to the frame of mind when I wrote Chaos Theory.
Next question here comes from Thunder BBX, and he asks, "What do you think is the most killer argument or worst argument made by MMT?" So I guess there's two things here. So the most killer argument against MMT, and what do you think is the worst argument that MMT proponents try to make?
Okay. Incidentally, many of you may already know this, but I would, if you care about this stuff, I put a bunch of time into it, so that's why I'm stressing. I want somebody to go look at it. On my recent Human Action podcast episode, I spent like an hour and 10 minutes going through a Warren Mosler interview, and then I realized I had so much more to say. Then on the Bob Murphy show, it's like the sequel to that, and I go like an hour and 40 minutes. And, you know, there's a little bit of redundancy, but not too much. So I would, if you're really into MMT, I would encourage you to go check those out. Okay, I think the MMT argument that on the surface seems so shiny and impregnable, and yet when you start thinking about it, it just collapses. They will say that government budget deficits are the accounting flip side of increases in private net financial assets. And Stephanie Kelton summarized it beautifully recently in a tweet when she said, we got to stop wringing our hands and worrying about government budget deficits. Their red ink makes our black ink possible. Okay? And so, and the MMT people just have run off with that. And I'll be real quick here. So what they mean is, like, there's a certain accounting truism involved. So what they mean is, if you just consider the private sector right now, and they want to say there's a sense in which it can't gain any net financial assets. So like if I'm a household and I save and I give $1,000 to buy a corporate bond, you might say, oh, didn't my financial assets of the household go up by $1,000? Yes, but now the corporation is $1,000 deeper in debt because they just issued that new bond. So on net, the private sector as a whole, which includes my household and that corporation, it's a wash. So if you get that's what they're talking about, then you see, okay, yeah, there's a sense in which the private sector as a whole can't gain net financial assets. Okay. And then they'll say, oh, but if there's this other entity that's outside the private sector, namely the government, and now the government runs a budget deficit of $100 billion, the private sector now has $100 billion extra in government debt. It's not a claim on anyone in the private sector. It's a claim on the government. So now the household's wealth has gone up by $100 billion, and there's no offsetting liability. So the private sector as a whole has just gained $100 billion in financial assets. So that's what the argument is. And you know, if you think it through and you know what their terms are, okay, it's true, given what the terms are. But who cares? And so, you know, you could do. There's different ways. The way I want to boil it down, say you could do that same approach. You could just draw a circle around anybody else in society. You could draw a circle around, Walmart, and then the rest of the world would be, you know, the world minus Walmart. And then you could make the same claim that the only way the rest of the world minus Walmart can gain net financial assets is if Walmart goes deeper into debt. So does that have any implications in terms of, if Walmart starts paying down its bonds, that means we're going to go into a recession? No. And then, but you might think, so it's just kind of like a true, but it's worse than that. And this is the last thing I'll say on this. Because at least with Walmart, how are they going to pay off their debt? You know what I mean? So if the rest of the world has claims on Walmart that Walmart owes us, whatever, $1 billion collectively over the next 2 years, how is Walmart going to pay that off? Well, they're going to have to go be profitable. They're going to have to buy resources and then transform them into goods and services that their customers value more than what they paid for the resources. So that's the net income out of which Walmart is going to pay off those bondholders if it does. In contrast, if the government owes the private sector, whatever, $100 billion collectively, how's the government going to pay that off? They're either going to stick guns in our faces and take the money and then hand it right back to us, or they're going to run a printing press. So of those two scenarios, in what sense would the group of, the mass of humanity want to have claims issued by either a voluntary organization like Walmart or the government? And yet the MMT people think, no, 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 really the only way we're really truly wealthier on net is if the government's running, you know what I mean? So it's just nutty the more you think about it. um, I hesitate to to pick any one thing. So I think normally people say the safe answer is to say let 1,000 flowers bloom and whatever interests you and go ahead and do that and da da da. But let me just stress, I think there's a big opportunity to get this stuff across when it comes to finding a real world application of why the Austrian insights are relevant. So it's not merely like an academic dispute. So like I say, like when it comes to Silicon Valley Bank or whatever, I was writing articles explaining why, hey, if we had 100% reserves, this wouldn't have happened, and and it wasn't an ideological thing. Like people could see, oh yeah, there is a problem with the current system. That's kind of nutty, and that kind of thing. So I guess that's what I would recommend. Just like people are never, the normal person was not going to see the problem with the taxi cab medallions until Uber came along, and then once Uber came along, and then the cabbies went to the government and tried to outlaw it because it wouldn't be safe for people to ride in some unlicensed car, and everybody knew Uber is perfectly fine, or it's no worse than cabbies, and so this is just your cartel. So I'm saying those types of things that I would encourage you when you're talking to people, like try to. A lot of people are not going to be interested just in the abstract academic or philosophical arguments, but if you can show why, no, in your actual life or your business, these insights are important, then that might give them an incentive to go study more to figure out, like, oh yeah, I really need to understand this stuff.
All right. Well, thank you very much, Dr. Murphy, for being on here with us tonight. Is there anything you'd like to let the people know about, or anywhere they can find you at before you go?
Again, just if you go to bobmurphyshow.com, you can see that latest episode and stuff in general. But that's a good place to go.
All right. Well, thank you very much for being here, Dr. Murphy. We appreciate it very much.
Thanks for having me. This was fun.
Absolutely. All right. So just one or two quick announcements before we leave. Again, like we said at the beginning.